Hey everybody, welcome back to the channel. My name is Mint. On the channel, I talk about stocks, investing, and finance, and I have a pretty large position in Palantir, about $28,000. So we're going to be doing a video today on why Wall Street doesn't get Palantir. Now, this video is not necessarily about criticizing Wall Street or criticizing the hedge funds or the big institutions or, the guys that basically control every single trade that goes on in America. It's more so about talking about what Wall Street generally looks for in a stock, why Palantir does not have those fundamental criteria, even though ownership percentage has gone up about 6% over the past quarter. So more and more institutions on Wall Street are becoming warmer to the stock. But sort of what are some of the fundamentals that Wall Street looks for, why Palantir doesn't get it, and ultimately why that means Wall Street just doesn't get the stock. Now, Wall Street is different than someone like Cathie Wood. And Cathie Wood is someone we talk about on the channel a lot because she has $1 billion invested into Palantir, and Palantir is one of the only stocks in a portfolio of 6 of her actively traded ETFs. It's that and Path. Those are the only 2 stocks in every single one of those ETFs. So obviously, when someone like her who has as much influence as she has puts $1 billion into a company, there is an outsized level of conviction that she has, especially because she's been buying the dip over the past really 2 weeks, mainly all of November, about like $40 million worth of stock that she's been buying in Palantir, primarily because she believes in something that Wall Street doesn't believe in. So there are 3 metrics for why Wall Street doesn't believe in Palantir and why they don't get Palantir, and we're going to talk about all 3 of those in this video today. Number 1 is about long-term investments versus short-term investments. Number 2 is Palantir's SPAC strategy. And number 3 is their potential to generate 30% year-over-year growth, mainly because of the fact that most of their clientele are governments and governmental institutions and not commercial sectors yet. So let's first talk about long-term versus short-term. Inherently, Wall Street likes to say that it's long stocks. And you would think about the nature of a long-term investment. A long-term investment, which is the nature of what any investment should be, is that you are putting money into a hopefully appreciating asset based upon some belief that you have on that asset in order for that asset to rise in value and then for you to sell at a later time. With the Shiba Inus, the crypto coins of the world, we are expecting to receive 1,000% on investments within weeks, which is, absolutely ridiculous because people don't get 1,000 increased investments in their life, right? Unless you're like venture capital funds, and even they invest into something in 2012 and then get the return in 2021, which is what Andreessen Horowitz did with Coinbase, right? It's like it takes time to be able to get a massive return on an investment, and we're getting conditioned as much as investing in stocks are becoming mainstream because of the culture, especially with Robinhood, the GameStop fiasco, it's pushing it into mainstream culture. It's also making short-term mindsets a lot more prevalent. Now, Wall Street is supposed to be an institution, and when I say Wall Street, I'm talking about the institutions that comprise of investors that actually purchase large amounts or allocate large amounts of capital to these investments or to these stocks, is not supposed to have that mentality, right? They're supposed to have a mentality that says we're putting in $400 million and we don't want to even look at it for the next 10, 15 years because we know it's going to come back at a higher rate. The problem is that's not how they think. And the reason that's not how they think, and it's important to understand this in the context of Palantir, is that the more riskier an investment is, the more likelihood the individual human beings on Wall Street that manage the hedge funds, that take percentages of management fees as managing directors of certain institutions, the more chance they have of losing their jobs. And that's because their jobs are bound by the fact that they have to return capital to the investors that give money to these institutions because they have to raise funds as well. And they take fees upon managing that money. And managing that money means they have to generate a return. Otherwise, they're not going to get the money in the first place. So when you put money into a high growth tech company, particularly a company like Palantir that hasn't reached the traditional metrics of what most investors are looking for, but rather is being evaluated on what it can do in the future, then you're going to have short-term mentalities from individual people within Wall Street that don't want to lose their jobs, right? Or that just generally don't feel the safest with an investment. Because institutions invest so much money, the opportunity cost of that money not generating a return is massive, right? So if you put $20 million into Palantir when it was $27, and Apple at the same time was trading at $143. Apple right now is about $170. Palantir is about at $19. It would have been much easier to justify taking that $20 million and putting it into Apple, right? Because no one would have questioned you on that investment, even if Apple had dipped below 143. There's sort of this natural belief that people are going to buy iPhones, so it's just not a risky investment. But now you look like an idiot because Apple's gone to 170 and Palantir has gone down 20%. and your investors are looking at you like, what are you doing, right? Like, we need you to we need you to get a return for us. We don't need you to go play around with some data analytics software that hasn't really proven anything to the world. So that's the first thing to understand. Palantir is one of those platforms, or one of those technology companies that is being evaluated on its future future revenue growth. They are cash flow positive right now, which is an awesome metric, but at the end of the day, it's not enough for investors to feel long-term into the stock that they're going to allocate immense amounts of capital to it. So even though institutional investment is rising within the company, that is one of the first reasons why Wall Street doesn't like Palantir. They don't understand the long-term trajectory of the company because they necessarily don't care about the long-term trajectory of the company, which is why they're ultimately not going to invest a lot of money into it. And this happens for a variety of growth tech stocks. Now, if Palantir starts running, right, let's say it goes from 20 to 40 in the next 2 months, that's when you're going to see more of that institutional interest still seep in. And a lot of it's going to seep in from a hedge position, because people are they're going to think it's so overvalued because of the things I just talked about above that it should be shorted. And you're going to get sort of some of the interest that, for example, Tesla was one of the most shorted stocks in 2019. Right? Because Wall Street didn't understand the potential of an autonomous vehicle network that leverages AI and big data at the highest of levels. And the product that Tesla was creating was just so superior to every other electric vehicle that existed, and the battery costs were getting lower. And like, they were shorting it when it was like $350. It was the most shorted stock on the market, and now it's over $5,000, pre-split, which is like ridiculous, right? So that's a really important thing to understand, that when Wall Street doesn't really get it, then there's a likelihood that they're just not going to invest in the stock. The second reason is a SPAC strategy. So the SPAC strategy is highly controversial. I did another video, I will link it again in the description, about what Palantir's thesis is around the SPAC strategy. A SPAC is a special purpose acquisition company. These are companies that are going public not through a traditional initial public offering of their shares, but rather a group of investors are raising a lot of money from other institutions, Palantir being one of those institutions that's investing in the SPAC. So let's say you raise $600 million and Palantir puts $40 million of cash into that $600 million. That special purpose acquisition company is like a blank check of $600 million that then merges with the company that's going public. Some of the SPACs that Palantir is invested in are like Sarcos Robotics or Babylon Health or Lilium. So these companies go public with the SPAC and they merge with Palantir being an investor. And a lot of times Palantir is also given those companies the Foundry software, which is their flagship data analytics software, because their entire SPAC strategy is investing in companies that are using big data to grow their businesses. And because Palantir is intrinsically, the world's most optimized data analysis software, they want to own a piece of equity in companies that are ultimately doing everything with data. So Wejo is a really good example of a SPAC that Palantir invested in. Wejo manages like tons of electric or autonomous car vehicle data. People are saying it's almost like a competitor to Tesla in terms of the amount of data that it has and the ability for it to analyze it. Wejo uses Palantir's software, right? So they're a customer of Palantir, and Palantir owns a piece of equity stake in the company. To me, I think it's a phenomenal strategy because you're betting on companies that have not necessarily proven to be the multi-$100 billion companies that they could be, but you're investing in them when they're early. This is a 10-year runway, and if they're using data and you as a company believe that data is the new oil, and you ultimately building every element of your software around optimizing data from a machine learning AI perspective, and all these companies are using that, then it makes a very, it's a symbiotic relationship for them to invest in those companies and for those companies to use their platform and for them to scale together with Palantir owning a meaningful equity stake. Now, Wall Street doesn't like that. And the reason Wall Street ultimately doesn't like that is because these SPACs are unproven, right? And again, as I said above, if a lot of your capital, and it's not a lot, but a decent amount of your capital is just going into these random SPACs, Wall Street would be like, you're spending $40 million in this investment. Why don't you spend that on sales and marketing so you can grow, year over year more faster or something like that? And Palantir is just like, well, we're not trying to grow year over year as fast as you want us to grow. We have our own sort of metrics, but we think that Wejo can be a competitor to Tesla. And if Tesla is a $3 trillion company and Wejo is even like a $400 billion company in the next 10 years, then that's going to be a meaningful return for us, not only from them being a client of us, but from also us owning a piece of the company in the first place. So because SPACs are highly volatile, they're highly unproven to be successful, and you need a long-term trajectory for these public companies to truly become the behemoths that we think they can become, and a decent amount of them could theoretically fail. That is the reason why Wall Street is also not or is much more skeptical, which leads them to be not as bullish on Palantir and their SPAC hypothesis and their SPAC strategy. A lot of companies have venture capital arms in which they invest in other companies and they allocate capital, but Palantir has sort of made this like deal, which is that, oh, like if we invest in these companies and they grow and we grow with them, then that's part of how we as a company grow. And Wall Street just doesn't really like that because that's not what they're betting on. They want to bet on Palantir, not these unproven SPACs that they're investing in. Again, I think if the SPACs are driven by data and Palantir is all about data, then it's a very seamless fit. And I think it's like a pretty genius strategy. Okay, last thing. Palantir has offered 30% year-over-year growth over the next 5 years until 2025 as sort of the realistic growth that investors should expect. And that's pretty phenomenal, right? And on their Q3 earnings, they lived up to that call. And they increased their revenue as well. Now, the reason Wall Street does not like this is because they think most of their clients are still governmental institutions, which they're not wrong about. But the thing is, Palantir is increasing their commercial clients, right? And like that's the thing that is hard for Wall Street to get its hand around, because if Wall Street ultimately thinks that most of your clients are coming from the government, and some of the biggest institutional clients of Palantir are ultimately governments, even though Palantir is doing an amazing job dissecting in the commercial sector. I mean, there were just a bunch of press releases that just came out. Palantir is working with Kinder Morgan. Palantir is working with Merck KGaA. I covered this on the channel. Palantir was working with Airbus since 2017, and I think in like June they established an even more formal partnership. So there's tons of institutional clients that are seeing the value in Palantir software and the ability for their software to optimize their businesses. I'm doing another video in the next couple of days about Palantir working with a Switzerland media company. It's called Ringier, and this was announced a couple months back, but like that in and of itself is making me start to understand how much of a commercial presence Palantir has to be able to operate with them. Now, because they're still primarily getting a lot of their money from governments, Wall Street also is very skeptical about this, because at the end of the day, we're talking about a company that should be, based upon its valuation, to reach $100, $200, you're talking about 80 to around $160 billion in market cap, right? Because it's around like 30 right now. So for it to double, you would have to get 60. It was at 40 a couple of days ago, but then it just dropped massively. So you're talking about a very, very multi-$100 billion market cap in order to reach a certain price level, which would generate a fantastic return, right? You're talking about 200-300%. So at that point, for Wall Street to believe that you can 200-300% the stock from where it is right now in the next 4 or 5 years, they have to genuinely believe. And the reason it's important to stress on that is because Palantir is a SaaS company. If you think of something like Adobe or Salesforce, Wall Street can give the sort of expectation that, okay, Salesforce is going to be in every company. Adobe is going to be integrated in every company. Slack is going to be in every company. These software as a services are actually going to serve their software to all the other companies that need these services from a B2B perspective. And B2B is big. B2C is big, but B2B is where the money is made, be it business to business. Palantir is intrinsically a business to business company, but all of their revenue is coming from governments that are using the software, or like a majority of the revenue. That's another reason why Wall Street is very skeptical. So from a Wall Street investor perspective, you can't necessarily blame them, because you're like, okay, if I can give you, a year or two to just prove to me that you can get commercial clients, then I can make the investment, and then it's not a big deal. The problem is if you don't recognize, or you don't have a fundamental belief that they are going to be used in every commercial sector of the entire planet, then you would be missing out on 100 to 200% gains if you're waiting for 2-3 years just to see that there's more commercial clients that are being listed in. But again, Wall Street cares about opportunity cost. They care about where the money could go that could be safer and a quicker return. And again, the quicker return matters, because these investors that they're raising money from want to hedge their positions to the point where they are guaranteed that capital is going to be coming back to them. Not, within 10 years, but every single year, every single quarter. So at that point, Wall Street just simply has different incentive structures and ultimately fundamental beliefs on how to invest in a company versus someone like a Cathie Wood that invests for the long term, has a 5-year horizon, invests in innovative stocks that she knows are going to disrupt industries versus be safe bets like Apple that probably are not going to innovate at the highest of levels as some other companies. So a couple quotes from Alex Carp. He said, "We told the Wall Streeters that we will focus on building the long-term health of our company, that we are going to invest in our product development and in our clients, and you just have to battle it out with them." He also says, "We're in this for the long haul. If you're speculating or you're thinking about this short term, there are plenty of other things to invest in. If you want something else, it's a huge world. Buy some other stock. You don't have to buy Palantir. No one is forcing you." Now, obviously, if it, on one hand, I'm like, yes, I like this from the CEO. He's like, you don't have to buy us. Like, go buy something else. Screw you. And that is a lot of confidence. On the other hand, I'm like, Yeah, but you got to sell the stock, though. Right? You got to get people to buy it. But ultimately, I agree with him. It's like, look, you're in it for the long haul. As a retail investor, I'm like, all right, I'm on your train, bro. Take me to the promised land, and I'm going to give you 5-6 years to get me there. And you just got to enjoy the ride while you're on that train. And the people that did that with Tesla from 2014 till 2019 were on that ride. And then 2020, that ride ended up taking them to the moon, and it's probably going to take them beyond the moon over the next 5-6 years as well. So, and if you enjoy that philosophy of investing versus just like this annual compromised return or compounded return because of like safe stocks like Microsoft or Apple or whatever, to each their own. But sometimes if you want to play on the wild side and really gain what you think you can gain because you've done enough due diligence to understand why they don't get it and these guys do, then you got to play with a little bit of fire. Now, the last thing I'll say is, sometimes it's a good thing when Wall Street doesn't get the stock, right? Now, it's not always the best thing in the world when Wall Street doesn't get the stock, because then they publish these articles, and then all these analysts from like JP Morgan and Bank of America, they put all this stuff out that lowers the price and that affects it in public perception and all that stuff. But a lot of times, the best investments are when people don't agree with these investments. So Airbnb, the Airbnb offered $150,000 for 10% of the company. So they were going to raise investors from 2008. This is like a $100 billion company now. And in 2008, when they were nothing, you could have owned 10% of Airbnb for $150,000. That effectively values the company at $1.5 whopping million. And if you just look up Airbnb rejection emails, you would see these VCs in Silicon Valley were like, yeah, we don't get it. We don't understand travel. We don't think the market opportunity is big, all this stuff. At the end of the day, if you don't get it, you don't get it. And I think one of the unique ideas about businesses is that what seems like a ridiculous idea has the potential to be one of the outlier companies that changes the world, because it's not supposed to be understood in the beginning. And if everyone understands it, you actually have a pretty lame idea, because then someone would have already done it, or too many people are already doing it, or it's just not interesting enough to inspire the entire world. And that inspiration of the world leads to attention, and attention leads to massive economics of scale. So when you think of a company like Palantir, I'm actually excited. These are my closing thoughts, that Wall Street doesn't get it. Because if Wall Street did get it, it wouldn't be what it is, right? And when Wall Street does get it, that's when they're going to be chasing the stock. And people like us who actually understand it, who are in it early, obviously we're taking a bet. But if you understand why you're taking that bet, then it's not that much of a bet. And then you literally just have to enjoy the ride until Wall Street inevitably gets it. And they will once the numbers increase. But once the numbers increase, it'll be a little bit more at a higher price threshold for them to really get into what the stock is and own part of the company. So those are my thoughts on why Wall Street doesn't get Palantir. Let me know your thoughts in the comments. Why do you think Wall Street doesn't get Palantir? And are you invested in other stocks that Wall Street also doesn't get besides Palantir? Look forward to reading your comments. My name is Mitt. This is the Daily Business Show. I'll see you in the next one.